have PTC Industries, the stock on our radar after its wholly owned subsidiary, Aerolloy, has signed a memorandum of understanding with Safran Aircraft to co-develop aircraft engine components. To talk about this and more, we do have Sachin Agarwal, who's the chairman and managing director of the company, who joins in. Sachin, first up, if you could give us a scope of revenue generation via this MoU. What does this mean? Because you had told post your fourth quarter results that you already have an order coming in from Safran for a few, few aircraft. What does this deal mean in terms of, in addition to what was your deal with Safran earlier? What is the revenue scope here?
Good morning, Mangalam. No, this is a bit different. The previous MoU and long-term agreement that we had signed with Safran Aircraft Engines was related to civil aviation, commercial aviation for LEAP engines. This is specifically related to military engines. So here the scope is quite wide. It's related to all titanium and superalloy and all critical material component manufacturing, as well as material supplies in various forms, right from billets, bars, sheets, plates. So it has a very, very wide scope and has huge implications for India in terms of Make in India, as well as the indigenous content requirements for the new policy that's coming in place.
What's the value of this? What's the potential value of this deal?
Well, that's a bit difficult to put in right now in terms of value of the deal, because it's right now in the form of an MoU, which will not translate like in the previous MoU that we signed with Safran. The MoU was then later translated into a long-term agreement and contracts. So that stage will come probably in a year or so from now. So then it will be a better point to give some value on this. But it has a huge potential, and it gels in with all the investments that we are currently doing in all these fields.
All right, Sachin, hi, good morning. Good to see you in. Thanks a lot for joining in. This is Nigel on this side. So you've given us few details with regard to this is military focused. The MoU is both for materials as well as for casting. And also you mentioned, I think it's going to be a mix of titanium as well as superalloy. Do we have any broad sense about which way it will be tilting towards? And what is the realization difference between the two, superalloy as well as titanium?
So normally in an engine, the weight is about split 50-50 between titanium and superalloys. In components, the valuation for superalloy is about in the region of almost, it ranges from almost like $400, $500 a kilo to almost $2,000 a kilo, or even going up to even $10,000 a kilo. So it has a huge range depending on the component. And similarly in titanium, it again in components it goes from almost $500 to about 2,000. In material supplies, it's also similar that in titanium, we're talking about somewhere between $40 to $40 per kilo, all the way up to almost $200 per kilo. And on a similar range on the superalloys materials as well. So they're very similar.
Right. This is one of the businesses that you've signed an MoU for. What about your other order book right now? I mean, where does that stand at? What is the visibility that you have? On this one, you said you'll probably get visibility, say, a year from now when it comes to value. As of now, with the orders that you have on hand, what kind of visibility do you have in terms of revenue for the next, this year and the next year?
So we currently have a reasonable amount of orders. We almost booked for, I think we in the region of close to almost having orders in the region of approximately 700 to 800 crores already in. We also expect that this financial year will be almost close to doubling our revenue from the previous financial year. So there is a very good visibility available in that sense. And then again, quite a significant increase the following year as well. So in terms of order book, we are very well placed. We have a substantial amount of capacities that are getting created, which will be unleashed in the financial year of 27. So again, then there will be quite a bit of increase after that as well.
All right. So for this year, We're looking at nearly, I think the last time around we'd spoken about this. This year you should end with in the vicinity of around 750 crores. That's correct, right? In terms of revenues?
Well, close to 700. I said almost double. So from the current financial.
700, 750 crores should be a fair estimate. And margins in mid-20s?
Mid to high 20s.
Mid to high 20s. All right. But the bigger year, as you mentioned last time around, is with capacities coming on stream and with the order book, picking up pace. FY27 appears like the bigger year. So this year you double your revenues, and on that base you more than double your revenues, right? FY27 you should be looking in the vicinity of around 1,700 crores or thereabouts.
No, I think the primary unleashing will happen in the financial year 27-28 rather than 26-27. The reason being there are a lot of qualification work that needs to be done on the new plant. So the plant will be up and running in about a year and a half from now, but the qualification work will start after that. So that will consume the next financial year to a certain extent. But but still from the domestic sources there will be still quite a bit of an increase.
Sachin, the rate at which your order book is growing, your revenue projections are, and at the same time you have been increasing capacities in titanium. We see that some plasma arc furnace, etc., going under trial production, etc., too. That has put a stretch on your working capital and your balance sheet, because I'm looking at cash flow from operations, and that has been negative for the last many years for a company like yours. So we're just trying to figure out at what point do you turn CFO positive, and what is your working capital outlook, working capital days?
So I think the working capital, I don't know which data you're looking at, but I think we have remained quite reasonably sustained on our operations. So there are two parts of our fund flow. One is related to the funding of the new plant, which is primarily going into investment in the new plant, which is in the tune of almost 800 to 900 crores currently ongoing. But on the operation side, we have remained reasonably well cash surplus, and which is also further getting funded or contributing to the investments that we are making. So the margins in this business, once the new capacities are released, are quite significant, especially in castings and the component business, where the margins, EBITDA margins, exceed 40-50%, especially also on a material side, where it's in excess of 30%. So with those levels of margins, I believe that there is no reason that we will be at any point cash starved in coming years.
All right, Sachin, I just want to understand your working capital days. I think the goal is to hold it around 100 days. Is that correct?
That's correct.
That's the number you like to maintain. All right. Yeah. And since you have bulk of your expansion that will be coming in FY 26-27 onwards, for FY 29, what kind of a revenue number could you give? What is the aspiration? And since margins will improve from year on, how do you see the number, pan out from there as well? So let's focus on FY 29, since you'll have the capacities fully on stream and you have visibility. Please go ahead.
So 29-30, we are looking at reasonably in excess of 2,500 crores of top line.
Okay.
Probably touching somewhere around 3,000 even in 29-30. So in terms of margin, I think we'll be easily sitting above 30% positively. So quite a reasonably high margin, as well as very massive growth coming.
So roughly 750 to 900 crore EBITDA is what you could potentially do by FY29 is what you're saying, right?
Yeah, almost close to 1,000, yeah.
Yeah, it'll be interesting because
29-30, I said, so not.
Okay, as of now, your market cap is 22,500 crores. So clearly the street is looking ahead and saying that you're going to deliver blockbuster numbers. We'll hold you at this aspiration. Thanks a lot for joining in and giving us some color. Maybe the next time around, you'll be able to quantify this potential that you have from this MoU. Appreciate you speaking to us here on CNBC.
Just before we let you go, would you have a target on return on equity and return on capital employed? Because you are investing so much, these two ratios would be, pressured in the very near term.
But I think the numbers, as I said, 29-30, the numbers already kind of tell you what the kind of returns can be made, we are currently making investments in the region of 800 to 900 crores with potential EBITDA margins of in excess of 800, 900 crores coming in the next few years. So that would give a very, very high ROE and ROC as well. Besides the agreement that we have just recently signed with Safran.
On ROE and ROCE?
Sorry?
Do you have a target on ROCE and ROE?
No, I don't have a target, but I do see a very high return.
Got that. Take your point.
And besides this agreement that we signed, in the next few months, we are signing many more agreements to come in the next 6 months. So which will keep you informed on that.
All right, take that point. Thank you so much for joining in and giving us your outlook on the business. With that,